Mr. Hui, many thanks indeed for joining us this morning. If I could talk to you first of all indeed about today's decisions, Malaysia and Philippines, what are you going for?
Well, we're expecting both central banks to raise rates by 25 basis points. I think, the inflationary pressure is very clear, and I think, as Linda rightly mentioned, policy rate remains below not just pre-crisis level, but also long-term averages if you look at both central banks as well as for many central banks in Asia. So I think, the urgent action for rate hike is very much necessary.
Many economists are saying that Malaysia will keep their rates on hold at 2.75%. The ringgit's close to a 13-year high. Are you one of the few people forecasting, and why a Malaysian rate rise?
Well, we think there are a number of factors at play. First of all, of course, food and energy prices are clearly putting upward pressure on inflation in Malaysia. But also, if you look at the underlying domestic economy, it's actually still extremely robust. And therefore, it does call for some degree of moderation. And not least, you also have strong loan growth in Malaysia as well. So I think all these put together, it does call for some degree of tightening by the central bank. In the previous meeting, they raised the reserve requirements, and we feel that the interest rate increase will be more appropriate this time round.
Now, the Indian story, Tai, I mean, clearly that's a bit of a surprise to many economists, purely because, again, they've raised it by half a point. Does that, do you think, prompt other banks to think, hang on a minute, let's be as aggressive? How does it change the playing field?
I think it does, prompt other central banks to revisit their strategies, and therefore, you may see more interest rate increase by other central banks. But that said, India's case is obviously very different from the rest of Asia, which are more exposed to exports, and therefore we think that other central banks may still take a more measured pace compared with India. For example, as you said earlier, Vietnam raised by 100 basis points. Again, you do see some degree of diversity in the magnitude of increase in interest rates across Asia. Most central banks will still opt for 25, but India opt for 50, Vietnam opt for 100.
I know that you're the head of Southeast Asia research, but you also once the former economist of Greater China. So I can ask you about China as well. I mean, what is their thinking at the PBOC about the Indian being aggressive and perhaps other rate rises? They didn't raise rates over this weekend. Many forecast they would do. What is the Tai Hui take on that?
Well, we think that China will continue to raise rates as well as reserve requirements going forward, at least because inflation is still relatively high and the economic growth that we've seen in the first quarter numbers are still pretty robust. And of course, the fight against the asset bubbles and potentially in the property market, again, that's not been won. So we feel that there is still a lot of room for interest rate increase as well as reserve requirement increase in China. But also, we're now starting to see currencies being more actively used as a way to contain inflation in China.
Quick question on this. Indonesian growth today as well, a forecast of 6.5%, slower than it was in March. I mean, is that a good thing?
Well, I think so. I think if you look at the growth in Indonesia, throughout the crisis, they've not had a recession, and therefore the trend growth of 5 to 6%, and what we have right now is still very much in line with trend. So some degree of moderation, I don't think is a bad thing. It does help to improve or enhance the sustainability of growth in Indonesia. So in that sense, I think a moderation in Indonesian growth is not necessarily a bad thing.
Now, Tai, final question if I can. Currencies are strong. You had a recent Asian roadshow to the US and to Europe, and the appetite, you were saying, for Asian fixed income is robust because they do see currency strengthening. What else were the clients saying on this roadshow?
Well, currency strength is clearly one of the attractions for international investors to continue to look at Asian fixed income, but also the fact that prudent fiscal position as well as strong growth prospects are also important ingredients to attract investments. But of course, some of the troubles in the West, whether it's the US fiscal position or sovereign debt issues in peripheral Europe, again, has prompted a lot of money going into emerging market funds. So all these put together, it does put emerging markets, including Asia, in a much more rosy position in terms of Asian fixed income.
Tai Hui, many thanks for joining us, the head of Southeast Asia Research at Standard Chartered Bank.